Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Some Fed watchers looking for two governors to dissent for the first time since 1993. The former St. Louis Fed President Jim Bullard telling us previously, I think that the Fed could resume its normalization process. September would be a natural focal point for that. Jim joins us now for more. Jim, welcome back, sir. Just how compelling is the case for lower interest rates today?
I think the policy rate's a little bit high for the current environment, and so I do think that the committee could set up a September rate cut at this meeting. I think the risk for the chair is probably that that gets priced in even more than it already is, and he can't preserve enough optionality going into September, but I'm sure he'll do a good job on that part. So I think the committee's in pretty good shape here.
Do you think that it's good to see dissent, that that's actually healthy and important right now?
I've always felt that dissents show, in some circumstances, they just show that there's a lively debate and that various points of view are being heard, and that can be helpful to the chair, I think. Sometimes the Fed gets criticized from all sides, and sometimes when it's always unanimous, you get criticized for that as well. Too much groupthink. So I think dissents can be valuable.
A lot of people are watching today's meeting and press conference for any clues of what type of pressure President Trump seems to be exerting, at least psychologically, on the Fed. I wonder how much of a cloud you think that is. As a former Fed member, I know you're probably going to say it doesn't factor into their mentality, et cetera, et cetera. At the same time, the rest of the market is perceiving it that way and is taking everything that happens on the FOMC as, oh, this person is running to be the next Fed chair. Oh, this person is just trying to show their defiance to the president's discussion.
Yeah, I don't know. I don't think the committee pays too much attention. There's a lot of data, a lot of analysis. That's the way the meeting works. It's a big formal meeting. And, I think every member takes their role extremely seriously. And if they feel like the data is pointing them in one direction or another, they make the call, and that's that. So I don't really think the theater affects that part of the discussion.
So, Jim, let's talk about the data and where we are by the time we get to September 17th. Two more CPI reports, two more payrolls reports. And there's an assumption right now from some that they've got to wait. And they've got to wait because they need to see the tariff pass through to consumers. How much will we see? And once they've seen it, to what degree will it hang around? To what degree will it actually be transitory? Or will it be sticky? Jim, is two CPI reports enough to draw any conclusions on that?
They're going to want to see that data going into September, and that'll carry the day here today, I think. And they'll, who knows? You can always get surprised by the data. You've also got jobs reports in there, so they'll want to see that before they make a decision. That'll be the basic idea. But I think the notion is that they've already put the recalibration policy on pause for the first 6 months of 2025, waiting to see what the tariff policy would be and whether it would feed through to inflation. They didn't really get anything out of that. And that's why the policy rate's sitting a little bit high compared to inflation readings and unemployment readings right now.
And James, do you think that it's fair to think that next year you're going to see some pretty significant rate cuts, not just because of the new Fed chair, but because you think it could be appropriate based on potentially ongoing disinflation?
I think it is going to be appropriate, and I think if they make two rate cuts this year, September and December, and then they follow that up in the first half of 2026, they would start to get to the neutral rate. What the committee thinks the neutral rate is, maybe 3% or 3.25% or somewhere in there. And that would be the exact rate that you should be at if inflation continues to decline toward 2% and unemployment continues to be in the low 4% range.
Hey, Jim, appreciate your input as always, sir. The former St. Louis Fed President Jim Bullard there weighing in on the decision later on this afternoon. Joe Amato of Neuberger Berman writing, macroeconomic policy supports a soft landing scenario. As inflationary pressures continue to soften, we believe the Fed has more flexibility to ease policy. Joe joins us now for more. Joe, good morning.
Good morning.
How much flexibility does the chairman have later on this afternoon?
Well, he's got a couple of his team members who are dissenting, so that puts, I think, him in a little bit more of an awkward spot. But I think the Fed has been in a process to normalize rates over the course of the last period of time, and it got derailed a bit by, of course, the tariff announcement. So I think there's still a movement toward that normalization process, which we think they're going to get back on track on. We think there'll probably be a couple of cuts this year, not today, of course, but probably in September and later in the year, reflecting the fact that inflation, while edging up a bit, has still been under control. And the labor market, while again solid, still showing some signs of weakening. The number coming in Friday is going to be one of the lower numbers we've had over the course of the last number of months.
How much is the bullishness in risk assets predicated on this idea that there will be 2 rate cuts from the Federal Reserve in 2025?
I don't know that broad market bullishness has got to be driven by rate cuts. I think you have within the internals, if you think about small caps. So small caps, I think, do need to see a movement toward lower rates and rate cuts. And that historically has been sort of a catalyst for small caps to rally. But I think what we've seen over the last number of months is the hard data has held up well, broadly. We've gotten some good news on tariffs off, of course, the panicky early April announcements, and I think the markets reacted to that. And many businesses are responding quite dynamically to this issue of tariffs and maintaining margins. We're going to see a little bit of margin pressure in this second quarter, but margins are still at pretty high levels, remarkably, because tariffs have been in place for a number of months now.
So it raises the question about earlier this year, how so many people wrote off the United States as being the biggest loser from some of these tariffs. And suddenly people are coming around to this idea that maybe that was too fast. Do you think that sort of the Fed is a sideshow to really the crux of who is going to bear the brunt of it? And our U.S. companies showing in all of these earnings reports time and again, they're doing just fine, better, in fact, than those in Europe.
I don't think the Fed's ever a sideshow. But as it relates to
it might be today.
The notion of tariffs, you have 3 ways it can go, right? You either put price increases to customers and they eat it. You put a little, you eat it as the company and pressures margins, or suppliers eat it. So it probably ends up being a combination of that. We've seen inflation tick up a little bit. There's signs of that right in the last inflation report, particularly around things like apparel and home furnishings. You see the margin pressure I referenced, and then we don't really have transparency to supplier income statements per se, but there's probably some pressure going on there as well. And remember, goods are only a portion of the inflation CPI number. It's not the full number. And like you referenced just before, right, services have been softer than expected.
I think Lisa was attempting to get you to defend your overweight in European equities. So let's be more direct.
The broadening
Can you defend your overweight in European equities?
We've moved early in the year to a theme of broadening out, right? U.S. certainly had, was the major driver of markets over the course of the last number of years, but we did think there'd be a broadening out. Now that broadening out would include small caps, value, non-U.S., right? We're very bullish on Japan. Europe, we think with fiscal stimulus, particularly out of Germany, I think is going to show improvement, and the relative valuations were attractive. So we upgraded our developed markets outside the U.S., which would include, of course, Europe and Japan. So we're sticking with that. We're not underweight U.S. because U.S. still has so many competitive strengths, particularly the tech sector. Like if you look at this second quarter earnings, S&P 500 earnings ex-tech will be flat. Tech's up 17%.
Yeah, but what's Europe's
tech? Which blends
tech?
to up 7, whatever the number comes
But what's Europe's tech? It's not weight loss drugs anymore.
It's not.
Novo Nordisk didn't
Europe
work.
is a more cyclical economy. So if you get higher nominal growth rate spurred by, they have lowered rates, you get some fiscal stimulus, the cyclical nature of Europe's economy will improve, and you have the relative value differential from a valuation standpoint. To me, it's not necessarily a long-term secular or strategic allocation per se. It was more of, I don't want to call it a trade, but it was more of an intermediate term opportunity.
Which is one thing that we've seen with respect to the dollar and sudden strengthening on the back of some of the announcement that we've heard with the EU and European Union and how the tariff agreement kind of got tied, and suddenly this realization maybe there'll be a little pain in Europe. And I just wonder, if you see a cheapening in European assets at this point, is that a buying opportunity or is that a sign that this trade is over?
Well, I think it represents a buying opportunity. You know, we're not looking for opportunities that last a month or two, right, in the context of allocating it to clients. So we're looking for something that has some legs to it. And we think the amount of fiscal stimulus that's going to go into the ground in Germany is massive relative to the size of that economy and the European economy. And we haven't seen that in a long, long time. So I think that does have some legs to it in terms of the opportunity. The dollar took a very significant pullback, right? So that's rare to see it move that fast, that much. We still think the dollar will grind lower over time, but because U.S. hard data is held up and rates have probably stayed up higher a little longer than expected, the dollar has come back.
Are you expecting any adverse developments in bond markets in Europe that might hold back that equity story?
We do worry a bit about that, right? You know, if you look at the fiscal situations of different countries in Europe, while Germany has lots of room to stimulate, there are other countries in the region that don't, you know, in terms of what their local bond markets are. So we are watching that closely in terms of the spreads in whether it's, you know, Italian bonds versus bunds or versus treasuries or what have you.
So
but I think they have enough room right now to stimulate.
So how do you play the European story at the moment? Someone might look at this situation and say, okay, I buy an ETF that tracks the Euro Stoxx 50. Is that the way to do it, or is there a better way to do this?
Well, we're an active manager, right? So we have strategies that manage, European stocks or what have you. So we're looking at high-quality global companies that happen to be domiciled in Europe that have flexibility. We'll get some benefit from a local economy being stimulated, but we're still looking for quality companies that have global reach.
That overweight, of course, Japan and Europe. Not on India. This just dropping from the President of the United States just moments ago. India will be paying a tariff of 25%. This just dropping from the President just moments ago.
Yeah, a huge disappointment for Narendra Modi, given the fact that they were looking for something closer to that 19% that we saw from Thailand. It raises this issue that we were talking about earlier. What were the main sticking points that ended up with a tariff agreement that was substantially higher than the region expected? And frankly, something that a lot of retailers in particular are going to have to factor in if they move their manufacturing there and produced a lot of textiles in particular.
This from the President, the statement just dropping just moments ago. Remember, while India is our friend, we have over the years done relatively little business with them because their tariffs are far too high. The President goes on to say among the highest in the world, and they have the most strenuous and obnoxious non-monetary trade barriers of any country, a 25% tariff for India.
Yeah, he also went on to mention Russia and saying that India has always bought a vast majority of their military equipment from Russia. They also are some big energy buyers from Russia. Suddenly, this goes back to what we were talking about earlier. This is a key negotiating tool. The geopolitical positioning, what the relationship is with different countries and Russia, how much they are going to connect with China, that is all part of the tariff negotiation in a very different way than previous years.
That's the latest on trade this morning. Joe, it's good to see you. Thanks for dropping by. Thank you, sir. Joe Amato there of Neuberger Berman. To extend the conversation, Heidi Crebo-Rediker of the Council on Foreign Relations. Heidi, welcome to the programme. I just want to pick up on two lines that came from the Treasury Secretary, Scott Bessent. We don't want to decouple, we just need to de-risk. Is that the more diplomatic way of saying we want to decouple, but we're not in a position to until we de-risk?
I think you hit the nail on the head. I mean, decoupling is actually, I'm not so sure that that's the best final objective anyway. I mean, the de-risking is really because we have vulnerabilities where we have put all our eggs in one basket, particularly when it comes to rare earths, rare earth magnets, and the related technology and some critical minerals, some other products as well. But China really dominates that space, and we're trying to de-risk in the U.S. But it's and our allies as well. But it's very, very, very difficult. China has the chokehold on those particular commodities, and I think they're going to continue to use them, whether or not USTR or Greer ever wants to talk about them ever again or not.
How much, Heidi, has the U.S. gotten more leverage when it comes to getting some sort of coalition of trade partners to work on tamping down on the threats that some perceive as coming from China right now? Do you think that they are in a stronger position if there is yet another 90-day delay?
So first, I think as to the 90-day delay, if it is what happens, I think that is the very best option right now. And the coalition of the willing is, to look at both the offense and defense. The offense meaning you want to be able to make the investments in all of the areas collectively that protect economic security from weaponization from China. You also want to make sure that if you're going to rattle the saber of Russian secondary tariffs or secondary sanctions, however you want to categorize them, that you have to be prepared if you impose those on China, that they're probably going to, reinstate some of those export control restrictions, because that is literally their choke point right now.
How much do you get a sense that has been the crux of a lot of the discussions, particularly with the European Union, but also Japan and certainly in Southeast Asia, which has been a conduit for a lot of Chinese goods into the United States through those nations? How much has that been one of the main discussion points and part of the negotiations versus just sort of an ancillary part?
Oh, I think critical minerals and rare earths have been key. All the other issues that Secretary Bessent mentioned on overcapacity, that affects everybody. You have both developed and developing countries that are feeling the brunt of the auto, the use of tsunami on a day like today, but the tsunami of Chinese auto exports flooding markets everywhere from the EU to Brazil. But I think, the one caveat is that because we have proven ourselves, unfortunately, to not be the most trustworthy trading partner, and one of Trump's big objectives is really to upend both the trading and the security system, the architecture. I think there's not a lot of trust out there, and one thing that you really need when you're dealing with a coalition and building a coalition is you need trusted partners. So we need to make sure that we don't lose that trust along the way in order to be able to implement collectively some of the things that we want to do on economic coercion.
Heidi, it makes me think of Canada, supposedly a North American friend of the United States of America, left out in the cold. And I've been surprised, and I know you are too, that the two key issues really that are left on the table, put China to one side. It's Mexico and it's Canada. And we're not hearing enough, I don't think, about what's about to happen. What do you think is about to happen?
So, President Trump has been very dismissive of any deal being reached with Canada. And we traded more than $900 billion in goods and services last year with Canada. They are the country to our north. It's not a small player. They're our closest partner in addressing many things, including our critical mineral challenge. We've, a lot of the investments that have been really for shared economic security have been together with Canada, because we are so complementary in terms of what we can both extract and refine and produce together for on the critical minerals front. So I think, I'm very worried about the fact that Canada has not been more front and center. In particular, Mexico has, it comes with a different set of issues. They're connected, but I think Canada in particular is one that I am truly worried about.
Heidi, do you think that's because they just haven't focused on it? Or do you think that's just a natural consequence of the fact that we have USMCA and we can renegotiate it next year? Which one do you think it is?
So, it's a good question. We do have the ability and obviously are going to renegotiate USMCA, but at the same time, the feeling that President Trump really likes to have all the cards to play, and feels like Canada has very few cards to play because they haven't diversified. They're so tied to the U.S. economy, and they're really trying to figure out how quickly they can diversify their energy exports, their critical mineral exports. They have a very comprehensive political backing for de-risking from the United States right now. I think that's unhealthy. But I do also think that that the president is going to use whatever leverage he has to strike the best deal he can. And but I do worry that he is probably more likely to be conducive to working with Mexico than he will be with Canada, and I'm worried about that.
Interesting. Heidi, thank you. Appreciate your time as always. Heidi Crebo-Rediker there of the Council on Foreign Relations. Claudia Sahm of New Century Advisors writing, the possibility of two dissents from Governors Waller and Berman is notable in terms of Fed history, but policy moves on agreement. Claudia joins us now for more. Claudia, welcome to the program. What kind of agreement can we make today at the Federal Reserve? What can we agree on?
I think it'll be really interesting to see if the committee is getting more comfortable, having more conviction in their, forecast that inflation may rise this year, but then, come back down. So I think a lot of this discussion around what are the risks of the persistently high inflation. We know from Governor Chris Waller that he sees those risks as very low, and that's why he's in favor of a cut. But is the committee moving in that direction of, moderating those risks, or is it are they still very much demanding more data to get comfortable with the idea of a rate cut?
Claudia, what do you think? And it matters a lot what you think, because the Sahm rule is often pointed to, and was certainly pointed to at the end of last year for the 100 basis points of rate cuts in the second half. Do you see the same cracks that Chris Waller is seeing?
I don't see this. I can see the cracks that he's pointing to. I maybe don't draw as strong an inference as he does. I do think it's time for the Fed to really be pivoting to, why are you waiting? What are you looking for in the data? What do you need to see with inflation, right? Like, focus on that, as opposed to we can wait. We saw a lot of discussion at the last press conference about, the economy is solid, the labor market is solid, so we can wait and get more data. And I think there are sufficient signs of weakening, and some of the softening, the risks in the labor market, they've been with us for a while. Like, these are not new. The low hiring rate paired with the low layoff rate, this is not new. And yet we do see signs of demand softening. We saw some of this looking at first half GDP numbers and hiring concentrate. Like, there are just a lot of signs that this is not a labor market that will hold up, indefinitely. And so the Fed needs to back off some using that as its safety blanket in terms of waiting for more data, and recognize those risks are out there. We hear a lot about the risk to the inflation outlook. We should be hearing some more about the risk to the labor market outlook as well.
There have been a number of people who've speculated that Fed Chair Jay Powell might take an even more hawkish approach to policy, might signal that the labor economy is in a good place and that they're balanced roughly in their mandates, in order to avoid accusations of political interference, that he's getting bullied by President Trump. Do you ascribe to any of those ideas, or do you think that that's a bit speculative?
The best way for the Fed to stay out of the politics as much as it can is to put its head down, parse through the data, be transparent, right? The data don't speak for themselves. We need to hear how is the FOMC interpreting the data? What are they looking for? Like, that's the message he needs to stick with. They're not going to win. The Fed will not win if it plays politics. Like, that's just not the game that it is well suited for, nor should it be doing it. So I think we should just get a lot more of their thinking and just lay it out there. That's part of the transparency. That's part of the accountability that comes with the Fed being the ones that make the decisions about interest rates.
So, Claudia, let's stay on the data. I just wonder if 2 CPI reports is enough between now and September to draw conclusions about how much tariff pass-through we'll get and how much of that tariff pass-through is going to stick around.
2 more CPI prints could give us information both on the tariff pass-through. I mean, the tariffs working their way through the economy, this is going to take time. And we could see ever rising tariff effects as we go into the September meeting. So, I mean, they're going to have a real explanation of how you would cut into a rising inflation environment. But we have also seen, months of the outside of the tariffs. Look at the housing services, look at the non-housing services. We've had some really encouraging numbers. A few more months of that could, really strengthen the case that underlying inflation, set those tariffs aside, underlying inflation is really moving back down to target. And that is a really important piece. And 2 more months of data in that direction can help bolster the case for a rate cut based on the inflation risks are less.
Do you think they're in a position today and through the summer to keep on saying the labour market is solid, so we have the luxury of waiting? Can they write that in the statement once again this afternoon?
Well, they can write whatever they want to write in the statement. I think it would be misguided. I mean, we have seen various pieces of information about the labor market that point to some weakening. And also, if you are running an economy with below trend growth, and that's, focusing on consumer spending, business fixed investment, kind of the core of it, that weakness does eventually show up in the labor market. And the Fed itself, its baseline forecast shows some weakening in the labor market this year. So it seems completely appropriate to at least be pointing to the risk, pointing to that outlook. I mean, that's, a very reasonable thing to be pointed out. And I think they'll be a little flat-footed if they just keep hanging on to the labor market is doing just fine, economic activity is doing just fine. Because I think that's a pretty one-sided reading of the data right now.
We'll see if we get that change at 2 p.m. Eastern Time. Claudia, appreciate it. As always, Claudia Sahm there, New Century Advisors.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.